My name is Jake, welcome to the channel. In today's video, we're going to do a Review My Pie video where I review subscriber portfolios. This is one of my favorite series here on the channel. It's cool to hear, I read every single one of your emails. I try to respond the best that I can, but it's so cool to see how different people all across the globe are approaching dividend growth investing. And I absolutely love reading your emails. So thank you for sending in your portfolios. If you're new to the channel, I have a couple series here on the channel that I like to talk about. It's pretty obvious. I like talking about dividend investing. I'm a pretty big dividend nerd. For those of you that are maybe new, I live down here in Austin, Texas with my wife. We have a little baby boy who's just over a year and a half. I talk mostly about dividend investing. I also review subscriber portfolios, talk about financial independence, real estate investment trusts, dividend ETFs. Those are the main topics that I talk about on the channel. But for those of you that maybe are new, I'm just a normal dude. I live in Texas. I work 9 to 5. I side hustle and, I'm thrifty and frugal and try to save for early retirement. We follow the FIRE movement, meaning, financial independence and retire early. And if you were to see me on the streets, that sounds weird. If you were to see me in person, I'm pretty normal. I don't know, but I am a little bit weird in terms of my sense of humor, I guess you could say. Well, speaking of sense of humor, so I got to share something with you. So this was really funny. So our little baby boy, his name is Lucas. He's a year and a half, and for whatever reason, the funniest, cutest thing happened this week. So I'm holding him, just walking around the house, and he's kind of doing his thing, and then all of a sudden I farted. And then he laughed. And then I did it again later in the week and he laughed again. So now I've trained him to every time that I fart or he farts, he laughs. And so I just heard, right before I was about to click film or record the video here, our little baby Lucas was walking or crawling up the stairs, and my wife said that he farted and then he laughed. Oh man, okay. I don't know. Half of you are gonna find that funny. Other half of you are gonna be like, click, and then you're already gone. Anyways, I don't know. That's just who I am. I don't like to take life and investing so serious. Investing is incredibly important, but I'm not one of those YouTubers that have to have everything perfect, and want to portray, I have their Lamborghini in the back of the film here or in the picture. I'm just a normal dude. And if you are normal and like talking about dividend investing, I think you're going to enjoy the channel here. So we're going to talk about, let's see here. So I'm going to go over a subscriber question. I got an interesting question here this week that I wanted to go over. Then I want to go over 3 portfolios. This is the 40th Review My Pie, everybody. It's absolutely incredible. So I try to do a Review My Pie every 3 or so weeks. The first portfolio is from a 20-year-old here in the US, the second a 37-year-old from Taiwan, and then the third a 34-year-old from the United States. The timestamps will be in the description below, as well as the portfolio links if they're there. And as always, everybody, I'm not a financial advisor. I'm just a normal dude. Just don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, everybody, I don't review the portfolios. I'm reading them live for the first time. So I just want to make it as genuine as I possibly can, right? So, but yeah, dividend investing, it can be a difficult topic. It can be a little bit confusing and intimidating and challenging. I try to make it very simple and try to make it as straightforward as I possibly can. But even then, learning about, dividend investing can be a challenge for some. And I'm sure, for some of you, learning about dividend investing, it probably looks a little like this. Oh my gosh. I love that movie. I absolutely love it. It's one of my all-time favorites. Chris Farley's amazing. All right, cool. So let's take a look at the first question here. So it's from H&M Johnson here. I'm writing this question without having listened or watched the whole. This is on a comment on a video that I made a couple months ago. Apologies if you answered in the video. You said that RYLD and QLD, these are cover call ETFs from Global X. They're really, really high cover call ETFs. They're income ETFs. They're not growth ETFs. Because of their income generating nature, should I take that to mean that you are not reinvesting the dividends And if not, what are you doing with the dividends that seems to be in excess of 118K a year, just referring to the money. So if I were to invest a ton of money into QYLD and RYLD, what am I doing? Am I reinvesting the dividends? And a follow-up question, how confident are you that these two ETFs will have dividend yields over 10% in the future? So, and are you offsetting that risk with less risky ETFs like SEHD? I'm not sure if SEHD is less risky from a dividend yield standpoint. I just figured it was, since the dividend yield is much lower. Well, this is actually, these are two really great questions. So the first question, no, I did not put all of the money from the sale of our house into RYLD and QYLD. It was only a percentage of it. So I lump summed invested into the portfolio. In hindsight, obviously, I wish I would have waited 6 months, but I did that, earlier in the year. But, you just can't, you don't know what the market's going to do. But in terms of and reinvesting the dividend, in terms of these covered call ETFs, the total return is not so bad. I mean, it's not, keeping up with the S&P 500. But if you do invest into these income cover call ETFs like RYLD and QYLD, you really are ideally wanting to use the income today. You don't want to, reinvest the dividend trying to snowball that way, because the taxes will kill you if they're in a taxable account. And then the total return, because the share price is generally going to go down over time. It's just the nature of these two specific ETFs. So whether you reinvest the dividend or you don't reinvest the dividend, it really depends on what you want to do. Just understand that your total return is going to be a little bit lower than an ETF. Well, in some cases, a lot lower than some ETFs like SEHD or the S&P 500. Okay. Now, in terms of the dividend yield staying constant, it likely will stay constant, but your share price is going to go down, right? So if the share price is going down, yes, the dividend yield will go up, but it will even itself out and adjust as the share price goes down. So something to take a look at. You can look at in Seeking Alpha, and you can check and see the share price. Here, let me just do it really quick, and I can show you what I mean by the dividend yield and everything. So you can see here that the price has gone down. And then if you go and you look at the dividend history, what you'll notice is it's kind of been inconsistent. It's gone up and it's gone down, but the share price has gone down, but the dividend has also kind of slightly been adjusted, right? So before, earlier in the year when the price was higher, you were getting a higher dividend yield per month. Now you're getting a bit of a lower or a smaller dividend with with the monthly income that it's generating. And that's just kind of how it is. If you're ever curious about that, go and check on Seeking Alpha or Yahoo or wherever and look at the dividend yield and see how the payout is adjusting, especially with these cover call ETFs. So that's what I would recommend there. Now, obviously I don't have a crystal ball, but this will give you a good representation of, what the share price has been doing. And then this is what I like to do. This is for me, the main thing is I go in Seeking Alpha and I look at the total return. And here you can see the total return. Now the blue is the S&P 500, orange is QYLD. So you can see, even though the dividend yield is 10%, your total return, the share price plus the dividend, is lower, right? And if you go over 3 years, you can see that the S&P 500 is kicking its butt. Now you compared that to SEHD. Look at SEHD. Look at SEHD in terms of the total return. SEHD is beating all three of them. So QLD, but the dividend yield is right around 3.5%. Just because it has a low dividend yield doesn't necessarily mean that that's the end all be all. In many cases, it tells a bigger story, right? But SEHD is one of the best dividend ETFs out there. There's a reason why so many people talk about it, right? It's because it's really good. The index of SEHD is incredible. So when you're looking at this, and by the way, you're not going to be able to do this with the free version. You'll have to do this with you can only do this with the premium version. If you want to sign up to Seeking Alpha Premium, I'll leave a link in the description below. You'll get, I think it's like 58% off. So it's, it's pretty cool. I just want to be upfront. I do benefit from it. Seeking Alpha, they do sponsor and support the channel. But if you do want to use this in Seeking Alpha, you'll need the premium. But it's kind of cool. Like, and just one other thing here really quick. Another dividend ETF that I like is DGRO, This is more of a growth ETF. You can see, kind of how they compare. Now, if you look at this from the price return, this is why a lot of people get mixed up or they don't really understand. If you go on Google and you just type this into Google, this is what you're going to see. But the dividends matter, and so you have to factor in what the total return is with the dividend reinvested. So yes, SEHD is a great way to balance the growth. And that's exactly what I do in my portfolio. Is I don't just have these cover call ETFs. They actually only make a small percentage of my portfolio, whereas I have a higher weighting into these dividend growth ETFs like SEHD and DGRO. So I hope that helps and answers your question. But I'm sure a lot of you, the reason why I'm sharing this is I'm sure a lot of you have a similar question because these cover call ETFs and SEHD, they're popping up all over the place on YouTube. And it's important to kind of understand how they compare and, what the purposes are of these ETFs. All right, let's take a look at the first portfolio from Richard here. He writes, hello, I hope things are going well on your financial journey. I am a 20-year-old who is a third-year college student majoring in finance. My goal for this portfolio is to build it up for it to become a secondary source of income in the next 15 to 20 years. I've been investing for a couple of years now, but started this portfolio in March of this year. My main idea about this portfolio is to buy companies that can and have grown their free cash flow, which do not have a super high price to earnings ratio. Some small details about the allocation. All of the 6% pies are dividend divided into 40%, 30%, and 30% within the pie. This means these stocks are 2.4, 1.8, 1.8 of the total portfolio. VOO, which is the S&P 500, dividend ETF from Vanguard, makes up 32% of the total portfolio. VIG, okay, I think you're just explaining here what's in the portfolio, which we'll see here in a second. Thank you for taking the time to read the email and to review my pie. Link is, okay, all right, cool. Well, so Richard, thank you so much for sending over your portfolio here. It looks like this is the key thing here for me. Is you're pursuing FIRE, but actually more so financial independence. And I think most people are in that boat, right? When they're maybe in their early 20s, they're thinking, well, I don't know what I'm going to be doing in 20 years. Do I want to be retired? I don't know if I'm going to have kids. Am I going to have a dog? Am I going to have a goldfish, that I'm going to have to take care of? Like, what are my worldly responsibilities going to be? I think it's a good goal to start off with this FIRE, or financial independence goal, and then kind of figure things out as, the years go by. So I think that's cool. Let's take a look at your portfolio. You have a healthy dividend yield. You didn't mention if this is in a taxable or Roth account. I'm assuming this is in a taxable account because you want to access it in the next 15 to 20 years, well before the age of 59 and a half, which you would need for a tax advantaged account. So let's see here. You got 26 holdings, a good healthy dividend. I like this dividend yield and I like the expense ratio. It shows that you got the fundamentals, right? The fundamentals are you don't have a high expense ratio, so you're not paying too much in fees. You don't have a lot of holdings, which is also a really good thing. I don't like seeing new investors have like 50 or 60 holdings. I think this is a good amount. And I like the dividend yield because as we just learned from the previous question, a high dividend does not necessarily mean a high total return, okay? So all the fundamentals check out. Let's check out the ETFs. You got VOO and VIG. Sure, okay, yeah, I mean, that's absolutely fine. VIG and VOO combined, they do have a little bit of fund overlap, but not enough to deter you, in my opinion, from bundling them together, right? You got consumer staples at 18, tech 12, industrials, energy 3. Okay, pretty clear. I mean, no red flags from my point of view. Walmart, Procter & Gamble, Pepsi, Coca-Cola, Kellogg's, and Dollar General. Interesting. Okay, so you got some really defensive companies in here. So I guess my thing here is Procter & Gamble is great. For 15 to 20 years, the only reason why you would really want to go heavy in Procter & Gamble is for that sleep well at night, right? 15 to 20 years. I mean, you could go heavier in, Target or Costco or maybe a little bit more growth oriented, but I don't, I kind of like it. It depends on the person. This really depends on if you're more risk averse or less risk averse. The reason why I think it's okay is because this right here. Because you have such a high allocation to the S&P 500, you're going to get the growth from the S&P 500. Because if you had like 80% of your allocation into this slice here, I'd say you're too conservative. You're too conservative. You need to probably bump this, lower this a bit. But I think given the allocation, it can make sense. And quite honestly, you most likely want to flip tech and consumer staples, at least for the first couple of years. And then in 10, 15 years, you could always swap them. Right now, I think that's the thing that I would consider before even looking at the rest of the slices here. Even consider bumping up your growth slices. And then as you get closer to your FI or your financial independence or FIRE date, then you can swap them a few years before. So that's something to consider. You got Microsoft, Apple, and Intel. Okay. It's a little bit high. What? Here, let me do some math here. 12%. What do you got? 0.35 times 0.12. 4.5%. Okay. That's fine. I can get on board with that. Industrials. The reason why many of you are going to know, I don't like having one company represent more than 5% of your portfolio. In my opinion, you're not Warren Buffett. You don't know, you can't predict all the winners. And so I like diversifying a little bit more. UPS, Lockheed Martin, Caterpillar. Yeah, really some blue chip companies. Johnson. This is a very, very blue chip company. You probably went, and researched Dividend Aristocrats, Dividend Kings, and then added them into the portfolio, which is not a bad idea. Berkshire, American Express. Okay. Consumer discretionary, McDonald's, Starbucks, Home Depot. Okay. Energy. Okay. Communications. Okay. I like that this is your lowest one. These two are your lowest ones. Okay. So I actually kind of like this. I like it. I like the holdings in here. You're really focused on quality. I like that you have a low dividend yield. I'm trying to think at this point, Richard, if I were to change something, it's a little bit more nitpicky, but I think really the only thing that I would stress is focus on, so your goal is 15, 20 years. Is this the allocation that you want to have at your target in 20 years? Because if that's the case, you may want to consider focusing more on growth now and then adjust the weighting as you get closer to that goal. I hope that helps. Thank you so much for sending over your portfolio. I think you've done your research and it absolutely shows. All right, the next portfolio is from Vikter. He writes, "Hi Jake, I'm 37 years old, fan from Taiwan, and been following your channel for a while. You said in your last video that you'd like more international submissions for the Review My Pie session. So here I am, giving it a shot for my very first time." Hey Vikter, thank you so much, man. Yeah, I get a ton of people from the US, and I would love to have more international submissions so that I can, 40% of you watching the channel are outside of the US. And so I'd love to be able to talk to that audience as well. This is how my current portfolio looks like. I started off this portfolio just about 2 years ago. I must say it looks quite a bit different than it was back then. In the beginning, I had way more pure dividend stocks like 3M, AT&T, British American Tobacco, etc. But then I thought, if I'm still 15 to 20 years away from retiring, it's better to have my focus on growth and capital appreciation. As for dividend growth, I have my focus on SEHD and a few other non-tech stocks with both dividend and capital appreciation prospects. I hope to see my review in the near future. Your opinion is highly appreciated, Vikter. Well, Vikter, thank you so much, man. I think it's interesting. The time horizon is the same. Okay. You're 37 years old. So you're 37. Now, this is the cool thing that I think everybody needs to understand. It doesn't matter if you're 20 years old or 37 years old. If your time horizon is the same, your investments will be similar, right? Now, if that 20-year-old, if Richard had a 40-year time horizon, then my feedback would have been quite different. But for a 15 to 20-year time horizon, yeah, I mean, the conversation is a little bit different. We got SEHD in here. Man, everybody is loving the SEHD. It feels like a bunch of YouTubers are talking about SEHD or something. Let's take a look at your holdings here. You got SEHD, SEHG, and you got VXUS. Okay. Really good ETFs, by the way. International growth and dividend growth. Non-tech, you got T. Rowe, Home Depot, Visa, Costco, Nike. Good allocation. I'm not the biggest fan of the 7.5%. You know why? See if you can get this under 5%, or see if it makes sense for you to have it under 5%. For me, I would definitely have it under 5%. You got Meta. You're probably feeling the pain now. Apple, but Apple is doing well, right? So this is so I want to make a huge point here, right? This is why I'm talking about don't take on the risk. You don't need to take the risk. Meta was a great company, is a great company, was at all-time highs last year, now is down trading at 6-7 year lows. Could you have guessed that 6 months ago? No, you couldn't. Imagine you had 10% allocated to Meta. You would be feeling the pain much more than if you had it at a reasonable 4 or 5%, etc. Right? Assume that Apple, right? Let's say the unimaginable happens at Apple and their factories overseas get shut down, out of their control, or something happens. And imagine that this were to get cut in half, right? Why do you want to take that much risk? Look at Google. What happened to Google this year, right? Like, even though they're great companies today, it doesn't mean that they're going to be great companies tomorrow. Nothing is guaranteed. They may have a competitive moat today, but what does that look like a year from now, a decade from now? And that's why I love indexes that are market cap weighted. You don't have to pick the winners. You don't have to have a crystal ball. And that is why I say on every video, don't take the risk. Why? It just doesn't make sense to me. So I hope that helps. I hope that you understand that. And now if you want to take a little bit more risk and you understand that and acknowledge it, then go for it. I mean, everybody's got, there's a reason why there's casinos in Nevada, right? But that's just my opinion. The tech here, you got some great companies in here. You have quite a bit of allocated to tech. You mentioned that in your goal earlier. Now, the goal here with investing in these software companies is to then, in the future, flip them, sell them, and then, potentially buy more SEHD or more Home Depot, for example, right? I like the portfolio, but I also kind of don't because of the risk. In my opinion, I would put these, even though these are great companies, right? Adobe, Tesla, Salesforce, Microsoft. If you could get the percentages, maybe, if you could review the percentages, and then if you wanted, add more to this SEHG, the growth ETF, right? Then you're not taking on so much risk. But that's just my opinion. I hope that helps. I do like the allocation. I like the way that you're viewing this. It sounds like you have a goal with this slice right here, the 45%, over the next 15 to 20 years, the total return of these will be higher than a lot of legacy traditional, dividend stocks. So thank you so much, Victor, for sending over your portfolio. All right, the last portfolio here is from Lucas. He writes, "Hi Jake, I enjoy your channel and appreciate a little input from you on my taxable portfolio. I'm currently 34 years old with a wife and 2 boys and have been investing for about 15 years before it was cool." I hear you on that. "We are not necessarily interested in retiring early, but would like to continue growing our nest egg so we can live comfortably on dividend income in the future, 30-ish years." Okay, so past 59 and a half. Okay. "This is a first world problem, but I'm a bit concerned about my dividend income is getting too high with taxes in mind." Okay. So yeah. So if you know that you're going to retire in 30 years, you probably want to go more in your tax sheltered accounts. Okay. Our taxable portfolio is a bit over $1 million and produces about $24,000 per year right now. We have about 800K in retirement accounts, 250 in traditional, and in a traditional 401k, and 550K in Roth accounts. I generally prefer to stick with ETFs, but sometimes can't help myself when I see a great buying opportunity with individual stocks. For example, Microsoft at $28 a share in 2012, Altria at $35 per share in 2020. I would really appreciate some thoughts on how to balance high dividend growth rates with lower yields with my portfolio, or maybe some ETF stocks that don't pay a dividend. I'm curious to know your thoughts. Regards, Lucas. P.S. Great name for your kid. Every country in Europe has a variation of the name. Yeah, Lucas. Hey man, that's awesome. So yeah, our little baby boy Lucas, we named him here with a K. And the reason why we went with Lucas is so that his German grandparents could say his name, while my parents here in the U.S. could also say his name. So first off, thank you so much for sending over the portfolio. I think, to your point, you definitely have first world problems. It looks like, so if I'm understanding this right, you have a 30-year time horizon. So does that mean in the future, 30-ish years? So that means you're going to be 64. That means if you know that you're going to be, you want to retire in the traditional, at a traditional age, you want to make sure that you're maxing out your tax advantaged accounts, right? Your traditional 401k, your Roth, your Roth IRA, your HSA, if you can get your hands on an HSA, and any other way that you can lower your taxable burden. So for example, for you do not want to invest into cover call ETFs. At least not right now. You could always do it later, but for you, taxes have to be on your mind, especially if you're, it sounds like you're probably a high earner as well. You may live in a high cost of living area, but in your situation, the dividend, and I mean this honestly, the dividend is irrelevant right now. It's irrelevant. You don't need the dividend because you have a 30-year time horizon. Sounds like you're a high earner. The dividend is a forced tax burden over those next 30 years. So what it sounds like what you'll want to do is, it sounds like you'll probably want to optimize your portfolio for a higher dividend growth. I'll give you an example, right? Take the example of Kimberly-Clark, which has about just a 3.5–4% dividend yield, but is growing significantly slower versus a Costco that has just around a 1% dividend, but is growing at 10+% a year, right? You want to focus on the hyper growth and not the current dividend. Like for example, the Altria is, as enticing as it is, the only good thing about there's a few good things about Altria, but the best thing about Altria is it's a qualified dividend. In your shoes, you want to focus, in my opinion, 100% on qualified dividends. You don't want to go any REITs, no bonds, no cover call ETFs, just good old fashioned qualified dividends in your taxable account. All right, so let's take a look at your portfolio here. It looks like you got the ticker over here. You got the amount of shares that you have, the price, the holding value. So this is the market value that you have, the average cost, and the profit of loss based off of your cost basis. The dividend yield, the yield on cost. So this is what I would recommend you do is when you're evaluating your portfolio, you need to have an additional column here that shows dividend growth over the last 5 and 10 years. In fact, you can actually get this really fast. Let me show you how you do this. So go to Seeking Alpha, go and upload your portfolio in there. As an example, you can do it with the free version or the paid version. Free, I think you can have up to 3 accounts. But what you can do is you can upload your portfolio, or you can do it manually. So you can actually log in and upload it, and then it'll transfer over each individual holding you have. But the key thing that you want is go over to the dividend section here and then go and find the dividend growth for every one of your companies, and then enter in the dividend growth into your spreadsheet, because you should be definitely taking a look at the dividend growth more so than the current dividend yield. And then what you can do is, then you can use the, dividend reinvestment calculator, and then you can calculate projected returns of what the dividend growth will do to your income over, a 10, 20, and 30-year time period, okay? So you're focusing on, this is good, but as I mentioned, for you, it sounds like the dividend growth is where you should be spending the majority of your time, right? So you have a good amount of dividend income, your dividend yield, you have a healthy dividend yield, but let's take a look at some of your individual holdings, right? So you got VOO, small caps, you got a financial company in there, you got SEHD, okay, 3M good, AT&T, Union Pacific. Okay, what I'm looking at right now is, do you have any bonds and do you have any REITs in here? Because that is what you do not want. Bristol Myers, Raytheon, Johnson & Johnson. You got some really, really good companies in here. You do have a lot of individual companies that trickled in with a few ETFs, but these are really good companies. You got Comcast, Skyworks, you got Archer Daniels Midland, great company, SEHY, okay, cool. Foot Locker, interesting. I don't see Foot Locker a lot. Okay, cool. Here you got the VIG International. Okay. Yeah, you got a lot of stuff in here. You even got a Canadian company, railroad in here. You got a VTV, the value ETF from Vanguard. What is do you have your allocation percentage on here? You don't. And it doesn't look like it's weighted. Let me see if I can do largest to smallest. Here we go. So your largest holding is VOO. You got ETF. So your largest holdings are in ETFs, which is good. Then you got Microsoft, SEHD. Okay. So what it sounds like is, you're on the right track here. I think, I like that you have a combination of high yield and growth, because then, you're getting a good balance of a good dividend yield. What I would focus on, if I was you and you had a 30-year time horizon, see how you can set up your portfolio where you have a 1 to 1.5% current dividend yield, but where you have a dividend growth rate of over 10%. That's the magic sauce there. That's the key. If you can get this to around a 1 to 1.5, probably 1.5 current dividend yield, and a dividend growth rate of 10 to maybe 13% over the last 5 years, which is never a guarantee of future dividend growth, but it just kind of allocates the right investments that are growing, at that, at those margins, right? At those rates. So that's how I would view this. Yes, you're going to have low dividend income, but your portfolio value is going to absolutely skyrocket over the next 20 or 30 years. And you're going to have so much flexibility. And here's the key thing. In 30 years, what you can do is you could take this VOO, you could then sell out of it if you wanted to in 30 years, but you're going to have $10 million in here in 30 years. You're going to have $10 million. And then you could take that money and then you could invest it more into SEHD, more into Altria Group, for example, which is yielding right around, a 9% dividend yield or whatever it may be. And the best thing is you can choose in which year you do it so that you're in a lower tax bracket. Okay. You follow me? So that's the reason, versus being forced to pay a 3-4% dividend yield, in taxes every year. That's just not ideal. It sounds like for you. Okay. But if I were to summarize, make sure you don't have any REITs in here, no bonds in my opinion, and maxing out your tax advantaged accounts first. See if you can get an HSA, all of that good stuff, and see if you can lower your current dividend yield and focus on the dividend CAGR, the dividend growth rate. So Lucas, thank you so much for sending over your portfolio. This is absolutely inspiring. I think it's great. I hope that this was helpful. Thank you so much for watching, everybody. I hope that this was helpful. I hope that you learned something new. It was kind of cool to see how, we had similar, time horizons, different portfolio allocation, different approach. And, I really liked how Lucas was taking not just a single account approach, but a holistic approach with maxing out, or at least leveraging his tax sheltered accounts with his taxable accounts, and also incorporating the thought of, how taxes play a role here. That's something that maybe when you're 20 years old, you don't think about. And that's what I've been talking about here more recently on the channel, is having that big picture view of how each individual account supports your financial goals. And, these accounts, these investments, they're just vehicles. They're vehicles to help you get to where you want to be in the future. And thanks for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.